With us now, Michael Cloherty with UBS, head of U.S. rate strategies. Let's start with that idea, Michael Cloherty. Who has their foot on the 2-year yield?
Well, the Fed does. So, with their guidance, they're sort of suggesting that they're going to keep rates low for a long time. They'll continue to hold this front end down. I think when you look at the bond market, you want to look at the Fed's actions in two different parts of the curve. So the front of the curve is all about what they're going to tell us they're going to do with the policy rate. The back of the curve is sort of QE driven, but the Treasury is issuing a lot more at the back of the curve than the Fed's buying.
So let's talk about the issuance here. Issuance is a flood of paper onto the market. And to be clear, that means yield up, price down. How much of that movement would you calculate?
So what's been surprising is how well we've been able to handle the supply so far. That said, it's just relentless. So if we look, again, only focusing on the long end, front end supply, during Operation Twist, the Fed sold $630 billion of 3-year and shorter treasuries, and it barely moved yields at all. So long end is where the supply matters. 7-year and longer auctions between March and October is going to be up 84%. So even though the Fed's buying, it's peanuts relative to what the Treasury is issuing out there. We think we're just going to see this steady weight of supply dragging yields a bit higher.
Michael, not a trick question, a genuine curiosity from me. What's the history of supply mattering in the Treasury market?
So generally, it matters at extremes. So it mattered a lot when the U.S. ran a surplus for 4 years, back around the turn of the century. So back then, we saw 2s 10s invert 50 basis points. 2s 10 swaps stayed positive that whole time. So you had this incredible richness of long treasuries back then. It mattered a little bit coming out of the last crisis when we saw, a lot. The Treasury initially issued lots of bills to handle the jump in supply. As they termed it out, it really did offset some of the effects of QE. And that's what we think right here is the issuance matters more than QE right now. The Fed would have to upsize enormously to offset this supply.
Well, let me throw this in there, Michael. What matters ultimately more, the outlook for inflation or the outlook for supply at the long end?
Right. So I guess within this, inflation will set a fundamental level for bond yields. Supply can, create some significant swings within that. So we think we're so low right now, there's just not much upside. I mean, we've seen a lot. We saw equities move pretty substantially in the last month. 10-year yields stayed in the 6 basis point range the whole month. So, you're just not seeing much of a hedge benefit from treasuries at these levels. That means there's less fundamental value in treasuries. Treasuries underperform corporates the vast majority of the time. The only reason you own a treasury is because when they outperform corporates is when the equity market gets hurt. When you lose some of that hedge value, that diversification value, treasury is fundamentally worth less.
This is such an important point, and it's one that a lot of people are highlighting this morning, saying that treasuries can no longer be a hedge, right? They no longer can be a ballast to your 60-40 portfolio. Do you think that it is too soon to ring the death toll for bonds acting as this ballast, or do you think that this is an accurate characterization?
I think at these yield levels, it's accurate. We back up a little bit in yields, and I think the behavior will come back. But with U.S. rates pinned at 0 on the front end, the Fed has repeatedly said they're not going to go through 0. If they do go through 0, it threatens disruptions in the repo market. When Uncle Sam has $20 trillion of debt to roll over, the last thing you want to do is interfere with the funding of those treasuries. So, at these yield levels, I don't think there's much benefit. If we cheapen a little bit, I do think it comes back.
All right. So can you give us a sense of where you start seeing value again? Just to give you a perspective, the 30-year Treasury yield right now, the highest since June at 1.51%.
Yeah, I think we need to sort of back up another 20 bips before we get a little more interested in them, before we get some of that hedge value back in the equation.